Yo, what's going on, everybody? It is Thursday, November 3rd. I'm doing this video on my iPhone today because for some reason the batteries in my other camera weren't charged. I got spare batteries. I don't know. I usually pop them in the charger. For whatever reason, they weren't charged. All right. Today was kind of a disappointing day. I got to be honest with you. I thought we are going to see a bounce off of yesterday's hysterical selling from the Powell comments. We're all monetarists now, folks. We're all monetarists now. Of course, that saying is a little bit of a play on words from a statement made back in the 1970s by President Richard Nixon, who said, "We are all Keynesians now." And that statement was attributed to the economics professor Milton Friedman, who is the father of monetarism. He's the guy that we got to blame today. And, in the current times when everything is dictated by monetary policy and monetarism, which is, as I've said many times, it's a sickness, it's a mental illness. I mean, classic case today, the Bank of England raised rates again, and they're just crushing the pound, and this doing it over and over again, and doubling up and tripling up on these failed policies. The Fed's rate hikes are not going to squash inflation. So we're all monetarists now, and the markets are driven, at least in the short run, entirely by this belief in monetarism and monetary policy. I have to say this. Atlanta Fed upped their fourth quarter GDP forecast again. Now it's at 3.6%. So we're seeing an upward trajectory in economic growth, which is exactly what I said was going to happen after we stabilized from the fiscal contraction in the first half of this year. But the markets are not paying, investors are not paying any attention to that. They're just looking at interest rates, and they're looking at interest rates from a negative point of view, which is, something I understand both behaviorally and also, I guess, a little bit fundamentally in the discounting effect it has on financial asset prices. But, like I've been saying, every rate hike now has a diminishing negative impact because the amount of increase relative to where the rate level was prior to that increase is just getting smaller. But the amount of fiscal impact is getting bigger. I mean, those interest income transfers are getting bigger, and that's one of the reasons why, we keep seeing economic growth. We had 2.7% in the Q3. We're looking at 3.6%. I mean, that's really, really good in Q4. But here's the problem. As long as we're in this condition, and it's really kind of like a psychological condition with respect to what's going on with monetary policy, the markets are just going to stay under pressure. Now, that doesn't change my view, medium to longer term. And even, I admit I'm a little bit disappointed that we couldn't see a turnaround. I am seeing a shift in some of the sentiment that had been bearish for a long, long time. It's moving more towards a neutral and a less bearish posture. And, that could be viewed as a precursor to a more of a positive market environment. But unfortunately now, the rate perception, interest rate perception is the overriding thing in the short term. And I'm afraid to say that tomorrow, when we get the October job report, I think we're going to see a pretty good number, above 200,000 on payrolls. And, right now, good news is bad news and bad news is bad news. I mean, it's just, the way investors want to react. So we'll probably see another down day tomorrow. And unfortunately, the NASDAQ, I mean, that's lining up to make new lows for the year right now. So all that's happening, and we're all monetarists now. And really, that's, at least in the short term, that's the only thing to really pay attention to. if that's your thing. I'm fully invested. When we get dips, I try to add more. I don't have like unlimited amounts of capital. I wish I had more capital to deploy, because I am absolutely sure, we'll look back at this in a period of time and say this was like, probably one of the best buying opportunities since the late 1970s, early 1980, 1981. But just got to be patient on this. Somebody posted up a comment. I don't know if you could see it here or not. I think the person was from Turkey, and he said, "Yeah, Mike, the Turkish stock market is up 100%, but if you're paying $300 a month rent one year, and the next year it's up to $800 a month," he said, that's not easy. And he said, if something like that happened in the United States, I don't think people will put up with that for very long. And look, I'm not going to dispute the fact, and I've always said that in an inflationary environment, or even in a deflationary environment, there's going to be a segment, some that gain and some that lose. That's just the reality. That's the reality of everything. I wish the world were such that everybody is just happy and winning all the time. In an inflationary environment, debtors lose, creditors and savers win, producers win, consumers lose. I mean, it's understandable, but like at the same time, if you say to me, yeah, but the market's up 100%, sorry, that's something you could take advantage of. Now, I understand that probably most people don't have the ability to invest to a degree that would completely offset, what they're losing out in terms of the decline in their purchasing power. I understand that, and I have empathy for that. But if you're telling me that, there are vehicles and there are things that you can avail yourself to that are out there that you could take advantage of, and you don't do that, I'm sorry, but that's on you. That's on you. I mean, you could also make the case that in the long period of low interest rates, people who were savers for their entire lives, they weren't making any money. They went through years and years and years of like, a Dust Bowl depression kind of a situation where they had like peanuts on their savings. So you don't feel sorry for those people. I never heard during that period of time when rates were low, people were complaining about the poor folks who were not earning anything, and that went to pensions, that went to all kinds of things. I didn't hear anyone complaining about that. Now, I understand that it sucks when prices go up. Don't think that I'm immune to that either. I'm not. But I try to take advantage of things, at least to leverage my situation a little bit, or to offset some of these negatives. There's always going to be negatives in your life. Everyone. There's always going to be negatives in everybody's lives. There's always going to be negative. I don't know how you could sit here and tell me, yeah, but the stock market is up 100%, and then you're crying because you're paying more rent. Yeah, I get it. You're paying more rent. But then at the same breath, you're like, the stock market just doubled, so take advantage of that. That's all I'm saying. That's all I'm saying. And even if it's not going to be a 100% offset of your situation, even if it's 10 or 15% or something, it's something, okay? It's something. And that's on you. I'm sorry, that's on you. And in every situation, there's going to be positives and there's going to be negatives. Nobody likes inflation. If you have to go out and you have to buy things and you have to pay rent, nobody likes that. But by the same token, if you're a business owner and there's deflation, and or if you're an employee and there's deflation and your wages are going down, I mean, the real cost of things are going up, okay? If your wages are going down, if your profits are going down, if your income is going down, if your assets are going down, real assets, that's the same thing. I'm sorry. So you can't, if you're going to argue one way, you have to argue both ways. I am a big believer in consistency. You have to be consistent on this. You can't say, hey, it's all about my situation, but that's how people think. It's all about your situation. And even if there are things out there that you can take advantage of, I mean, how can you say to me the stock market is up 100? I mean, literally, it was like in the same sentence, hey, I'm paying more for rent, but the stock market is up 100%. Hello, open up your eyes. That's being given to you on a silver platter. Now, unfortunately, we don't have the stock market up 100% because the reaction now from all these monetarist zombies is to sell stocks. So the market is still, it's still struggling. It's still struggling. And we had that rebound in October, which I said we were going to happen. And I did say, I'm going to be honest about it. I did say that November is going to be a good month because we have the quarterly interest payment. We got big, strong, positive fiscal flows this month. And that's one of the reasons why I think you're seeing this upward revision in fourth quarter GDP. And don't forget, increasing economic growth means increasing profits. Increasing profits, earnings when they get reported, they're going to be higher than a lot of these companies right now. The problem, too, is that a lot of these companies, while they're beating on their earnings, okay, most companies right now in the reporting season, they're beating on their earnings. But the problem why you see them get smashed, the stocks I'm talking about, is because the guidance they're giving is very, very cautious. And I gave you a whole story about that. I said, years ago when I was on the Fox News panel with, what's his name, Jack Welch, who was the former CEO of General Electric, I gave you that whole story. He was very, very negative on the economy, and that was in 2003 when George Bush put through the stimulus. Everybody got a $300 check. And I said, the economy is going to expand. Things are going to get better. I was right. But, nobody's going to listen to me when I'm sitting next to, what's his name, Jack Welch, who said, no, it's terrible, it's horrible. It's not their job. They're looking at their book. They're looking at their order book. In economics, we call that coincident indicators. Okay, those are things that are kind of like happening now. What's on their order book? Could they even be for December or next March? That's coincident. That's kind of like what's happening now. By December or March, their customers may be in a completely different situation. Their businesses may have picked up. They're going to order more. And suddenly what's going to happen? You're going to get better guidance from these companies. But right now, and again, I said it's also, they don't want to be, they got to sign off on these earnings and the guidance and stuff like that. And they're held legally responsible for that. They can't purposely mislead. So it's like, that they intentionally, they're cautious so that they could, when they come in with the actual earnings, that's why it beats most of the time. I wanted to do a video on, somebody asked me to talk about Social Security, and I definitely want to do that. But I want to do it on my other camera. It's just easier for me to edit and, put charts and things like that and graphics, so I'll do that. Somebody also asked me a question about what I think, and this is a very interesting question, and I've been pondering this now recently, what effect the midterm elections are going to have. And right now, it looks like the Republicans are going to win big time. It looks like they could take control of Congress, both the House and the Senate. And I don't know what the market reaction is going to be, but my guess is that the Democrats, and I'm not saying this from, coming from any particular personal view of alignment, all right? I'm just saying, I think that the view in the markets is that the Biden administration and the Democrats have been a failure economically. Okay, they're blamed for inflation. Fed policy, rates going up, certainly inflation. They're getting hammered on that in the polls and the surveys and stuff like that. I haven't seen any proposals by the Republicans as to what they're going to do about it. And that actually politically, as a strategy, that's smart, because you don't want to, you don't need to say anything right now. All you have to do is keep hammering the Democrats on, look at the inflation, look at the inflation. It's your fault. You don't got to come up. But I have a feeling that if the GOP wins big on Tuesday, in other words, gets control of Congress, you could see a big rally in the stock market on the notion that, hey, we're finally going to get a change in leadership, a different party in control. They're going to do something. Now, I don't know how long lasting it'll be, but that's my view right now. I could be completely wrong on this, but I stick to what I do, which is, looking at these fiscal flows and these gigantic, transfers of money between the government and the non-government. That's my core. That's the core of my analysis. So when it comes to politics, this is just my speculation that I think if the GOP wins, we could see a relief rally based on the idea that, hey, we got a new regime in place. Yeah, you still have a Democratic president, but it may lift some hopes. And also, this may or may not be correlated, but I have seen some improvement, like in these sentiment surveys recently, especially the AAII weekly sentiment survey. And I think that is, that's correlated with a rising probability of a GOP win on Tuesday. Okay? I think that's what that is. That it's starting to reflect that people's sentiments are like, gee, if we can just switch parties, we get something going in the economy, it'll be a lot better. We get inflation under control. So we'll see what's happening with that. Anyway, I'm going to do a video on Social Security. Just be patient on that. I got to charge up the batteries, and maybe I'll get to do that tomorrow. All right, everybody. Have a good one. Bye.